Hey everyone, welcome back to Corporate Decoder, the place where we try to cut through the corporate jargon and find the real story behind these filings. Today we are diving into a GPO Plus Incorporated filing a 10Q report. And let me tell you, there are some interesting numbers in here that paint a pretty clear picture. Before we get into the nitty-gritty, if you are someone who likes to understand what is really going on with companies beyond the press releases, make sure you are subscribed. We break down these complex documents so you don't have to. And hey, we have a Discord community that is linked in the description below where we talk through these findings and more. So what exactly is this GPO Plus Incorporated up to? This is their quarterly report, essentially a check-in on how they are doing financially. For the period ending the 31st of October 2025, they are showing us the nuts and bolts of their operations. Now here is where things get a little hairy right off the bat. In the balance sheets for the period ending the 31st of October 2025 and the 30th of April 2025, we see a substantial stockholders deficit. This essentially means that the company's liabilities are greater than its assets. For the 31st of October 2025, that deficit stands at a whopping $7,568,967, and it was even larger at $7,292,313 on the 30th of April 2025. This is a big red flag telling us the company owes more than it owns. Financially speaking, this is not a strong starting position. When we look at how much money they are making and losing, the picture becomes clearer. For the 3 months ended the 31st of October 2025, they reported revenues of $1,569,108. That sounds good, right? But then we see their cost of revenue was $1,197,965. This means their gross profit was only $371,143. And when you factor in all their operating expenses like general and administrative cost, professional fees, and salaries, operating expenses were a staggering $865,845 for that same 3-month period. This results in a loss from operations of $494,702. For the 6-month period ending the 31st October 2025, the story is similar with a net loss of $1,275,550. The company is consistently spending more than it earns. They do say revenues increased compared to the previous year, which is a positive sign. They attribute this to an increase in inventory availability, so it seems like they are getting product out the door. For the 3 months ended the 31st of October 2025, revenues saw a 32% increase compared to the same period last year, reaching $1,569,000. Similarly, for the 6-month period, revenues climbed 20% to $2,871,000. So the top line is growing, which is good, but the bottom line is still in the red. Let us dig a bit deeper into their liabilities. Their accounts payable and accrued liabilities, which is essentially what they owe to suppliers, and for things like payroll were $1,480,946 as of the 31st of October 2025. This is a pretty substantial amount, indicating they are managing a lot of short-term obligations. And then there are the promissory notes. As of the 31st October 2025, they had promissory notes payable of over $3 million. That is a significant chunk of debt. The fact that it mentions a debt discount means they likely issued these notes at a lower price than their face value due to certain conditions or warrants attached, which is common but still indicates a need to finance their operations through debt. Looking at the changes in their stockholders' deficit, we see a lot of activity around stock issuance. For the 6 months ended the 31st of October 2025, there were several instances of issuing common stock for loan inducements, loan extensions, promissory note repayments, and conversions. This indicates the company is actively using its stock to manage its financial obligations, which can lead to dilution for existing shareholders. For example, during the 6 months ended the 31st of October 2025, they issued over 1 million shares of common stock as loan inducements and for term extensions on promissory notes. They also issued another 1 million shares for promissory note repayments and another 2.8 million shares for convertible note conversions. Then there are another 2.3 million shares issued to consultants for services. That is a lot of new shares hitting the market. The narrative around their promissory notes payable is quite detailed. They have multiple promissory notes with varying maturity dates and interest rates. Some of these notes are convertible, which means the lenders can convert their debt into company stock. This is a dual-edged sword. It provides capital, but can severely dilute existing shareholders if the stock price is low. The details about conversion rates and VWAP, or volume-weighted average price, all signal a company in a constant state of financial renegotiation. Now, the company openly addresses a significant concern in their filing the going concern note. They straight up say that they have incurred a cumulative deficit of over $45 million, and that their current revenue is not enough to cover operating costs. This means there is substantial doubt about their ability to continue as a going concern for a reasonable period of time. They plan to get more capital through debt or equity financing, but state there is no assurance of success. This is the most critical takeaway from the filing. The company is on thin ice financially, and on the internal controls front things are not much better. They state their disclosure controls and procedures are not effective. The reason given is that they lack segregation of duties with one individual handling multiple critical financial tasks. This means there is a higher risk of errors or even fraud going undetected. So what is our take on GPO Plus Incorporated? The financials clearly show a company struggling with profitability. While they are generating revenue and growing that revenue, they are not yet profitable and have significant debt obligations and a large stockholders deficit. The issuance of stock to manage debt and operations is a common strategy for early stage companies, but it comes with the significant risk of diluting existing shareholders. The lack of effective internal controls also adds another layer of risk. They are in a tough spot and need to secure additional funding to continue operations. Their strategy of expanding their distribution network with their white glove DSD service and mini hubs sounds promising, but the financial realities of the business are stark. It is a high risk, high reward scenario, without a significant turnaround in profitability and a clear path to sustainable operations. The long-term outlook remains uncertain. Alright, that is our breakdown of GPO Plus Incorporate's latest filing. What do you think about these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And of course, subscribe for more deep dives into corporate finances. Don't forget to check out our Discord community linked in the description. It's a great place to discuss these reports and share insights. Thanks for watching, and we will see you on the next one.